Early last week, the cryptocurrency markets were once again rocked with a meltdown. Panic throughout crypto markets was rampant as traders, investors, and speculators feared another Three Arrows Capital meltdown was unfolding, just like last July. Was FTX, the third largest crypto exchange in the world, and its leader, Sam Bankman, the most recent emperor with no clothes in the speculative world of crypto, going to cause a financial meltdown in other risk assets? I'm Chris Parrish, Chief Investment Officer with Oak Harvest Financial Group in Houston, Texas, and this is our investment team's midweek release, when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise for your money? This week, we discussed last week's cryptocurrency carnage. For the last few years, we've been asked by prospects and a few clients if we invested in cryptocurrencies for our retiree clients. The answer, time and time again, was no. My sarcastic answer was usually, I've been managing money for over 30 years now, and I've learned enough ways to lose money. I don't need another one. Well, apparently many newer investors, as well as crypto visionaries, are once again learning a couple of hard lessons. Last week, one of the largest cryptocurrency exchanges, FTX, had what is known as a bank run. On Sunday night, November 6th, Binance CEO, another large international cryptocurrency exchange, tweeted, yes, he tweeted, because that's what crypto markets are, they're the Wild West and largely unregulated, that they were liquidating their $580 million holdings in their competitor FTX native issue FTT crypto token. This caused FTX issued cryptocurrency token to plummet on Tuesday, wiping out over 85% of its value since last week. That's after it was already down 50% from its mid-2022 highs. These actions caused a cascade of selling across crypto markets as contagion fears spread and even trickled into stock and bond markets. Until recently, Mr. Bankman had been hailed as a savior of the cryptocurrency industry, swooping into the rescue of failing crypto firms in the wake of the Terra Luna crash last summer. He offered credit lines and bailouts. I mean, only 6 months ago, Mr. Bankman had a paper fortune estimated at $24 billion with a B dollars. After last week, depending on what cash he has in the bank, he might still make the billionaire list, but his company, FTX, will likely be wiped out. So what happened? Well, it's the Wild West of unregulated crypto speculating. So what happened is someone leaked a copy of Bankman's Alameda crypto trading hedge fund's balance sheet, and it seemed to show that about $6 billion of Alameda's $14.5 billion in assets were exposed to FTX, either through holdings of FTT tokens or as FTT collateral. FTX also had more than $1 billion of exposure to some other cryptocurrency called Solana Sol, as Bankman was an early investor in Solana. This quickly led to concerns that any fall in the price of FTT, which was issued by FTX itself and backed by nothing I can figure out, could collapse the entire group, which seems to have been what happened. Why have we avoided cryptos for prospects, clients, and retirees? One, because cryptos are barely regulated. The sector is the Wild West of financial services. It's been proven full of fraud and facilitation of criminal activity over the last few years. And two, there was little to no income generation in crypto, so they seemed of little use to retirees needing cash flow. Three, the industry almost had no transparency, and we couldn't figure out how participants were legitimately being paid interest to lend their crypto back to exchanges for trading assets that were fabricated out of thin air. High teens interest rates seemed too good to be true to us. Finally, we looked at the asset of Bitcoin over the last decade and viewed it from the lens of the Federal Reserve, adding or subtracting liquidity to the markets. We found what this chart by Alpine Macro shows. Crypto has largely been a speculative liquidity-driven asset. The Federal Reserve eases, crypto like Bitcoin goes up. The Federal Reserve tightens, crypto plunges. Is the news of the latest crypto crash news for your money? Well, if you're trading crypto, yes. Or if you have money at one of those exchanges, yes, unfortunately it is. However, if you're using long-term custodians like a Charles Schwab, a Fidelity, or other, the fear of the crypto contagion spreading to other financial players should be quite small. Are you trying to meet your needs or your greeds in retirement? Give us a call here and schedule an initial consultation with an Oak Harvest advisor. We'll sit down with you and help you and your family do the math to figure out if you'll be able to meet your retirement goals and your needs in retirement. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain. That's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here in Houston at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and from the whole team here at Oak Harvest, have a blessed week.